European online retailers are struggling with enormous bureaucratic hurdles in doing business with the UK. A Swiss solution should help them. Online retailers don't like special cases. The dress, the glasses, the outdoor equipment have to be delivered smoothly and in the shortest possible time from the manufacturer to the customer. None of this is a problem in the EU internal market. Online trading with non-EU member Switzerland has also established itself largely smoothly. This type of cross-border trade between EU countries and Switzerland is the business model of the St. Gallen family company MS Direct. Founded in 1978, the company now employs over 1,000 people at 7 locations and offers mail order companies and e-commerce companies numerous services. This ranges from the outsourcing of call centers to software solutions. And then came the dreaded special case. The UK said goodbye to the EU internal market on January 1st of this year. The British bureaucracy was in top form. There were suddenly new customs duties, new forms, new declarations, new certificates, new customs numbers, new taxes. Now, the kingdom is not a country like many others when it comes to e-commerce. With a volume of 113 billion euros, the British e-commerce market is the largest in Europe, with phenomenal growth rates in recent years. When it comes to e-commerce spending per capita, the British are world champions. Because the trade agreement with the EU came about at extremely short notice, events precipitated. The images of huge traffic jams with trucks trying to deliver goods from Great Britain went around the world. Companies such as the German parcel service DPD temporarily stopped the cross-border transport of parcels. The German fashion retailer Weber also temporarily removed the island from the delivery list. Missing or incorrect data led to goods being destroyed en masse, both on the continent and in Great Britain, because repatriation to and from the island kingdom was no longer profitable. In January, imports to the UK were 2/3 from normal levels. Since then, mail order companies from the EU have been knocking at MS Direct. As a rule, they are medium-sized e-commerce companies such as the Berlin-based optics company Mr. Specs, which also sells its products, and that means glasses, online. There is even an eye test via smartphone and computer on offer. The German outdoor specialist Bergfreunde is one of the new customers. Another 15 online retailers are currently on the list. And they say, we expect 25 to 30 new customers this year, explains Vincenzo Montinaro, member of the management. And it should continue on this scale in the next 3 to 4 years. Cross-border business with the UK is expected to grow to 15 to 20% of total cross-border business this year, according to Montinaro. The family company does not make public what that means in terms of turnover. They see themselves in a pioneering role in e-commerce. How long the St. Gallen can play this card is not clear. We are aware that different competitors are working on the solutions, says Montinaro. In the meantime, this creates new jobs. Our solution for the UK business is essentially a data-driven integrated software solution, explains Montinaro. Therefore, specialists in the areas of IT and customs clearance are being sought. Finding them, as we can see in St. Gallen, is not easy. The customers should be relieved of the complicated regulations at the border. This includes, for example, the customs declaration, which is made more difficult by the fact that the customs tariff numbers in the EU and, more recently, in the UK are no longer identical. With artificial intelligence against the flood of paper, so to speak. Because this is also the case between the EU and Switzerland. MS Direct teamed up with the University of St. Gallen and developed a solution based on artificial intelligence. This solution is also to be extended to the UK business. Goods from the EU are delivered to end customers in the UK within 48 hours. According to MS Direct, efficient local returns management can also minimize the risk of returned goods ending up in the waste incineration plant. The St. Galler work together with a customs broker in Great Britain. In this way, online retailers can avoid the obligation to establish their own location in the island kingdom. This broker is also used to settle taxes and fees that are borne by the trader. The end customer in the UK does not notice any of this. For the actual logistics, that means the transport to and from Great Britain, MS Direct also works with local companies in Great Britain. So that is one of the benefits for Brexit, but not for the UK. And the UK and the EU have already begun to diverge in the way they oversee financial markets, as hopes the two will reach a broad agreement on supervisory equivalence in the wake of Brexit fades. Britain has outlined tweaks to areas including the rules surrounding equity, fixed income, and commodities trading just months after the end of the Brexit transition period on December 31st. The subtle rule changes strike at the contrasting philosophies between the EU and the UK on how markets should be regulated. Among the potential changes, the UK plans to scrap caps on the amount of trading done in dark pools, private venues where investors can trade shares without signaling their plans to the rest of the market in advance. It is also weighing changes to how much information is provided publicly, both before and after the completion of trades in the stock and bond market, and to remove limits on the amount of commodities contracts traders can hold. The EU's priority is to develop a more harmonized internal capital market. By contrast, UK politicians view Brexit as the chance to return to restore powers and discretion to regulators and exchanges, lost by layers of detailed and prescriptive EU rulemaking. UK politicians want to give watchdogs greater leeway to write technical policy. Exchanges and trading venues may also have greater freedoms in policing their users and products, according to a Lords Committee reviewing the future of UK-EU relations. The UK was always an outlier in Europe, said Kay Swinburne, Vice Chair of Financial Services at KPMG and a former member of the European Parliament. Swinburne drew a comparison with the US system. In the US, self-regulatory organizations take on a lot more responsibility rather than relying on the regulator. The EU has never believed a financial market infrastructure is suitable to be self-regulated, she added. Alignment between Britain and the EU is largely dependent on the EU recognizing the UK standards as equivalent. With the UK looking to diverge, the EU has approved only 2 temporary permits, which grant UK institutions more direct access to customers in the bloc. But politicians and business executives' attachment to the framework is waning, and its value diminishing with every passing week. You can't have divergence and equivalence, said Merritt McGuinness, the EU's financial service chief, on Tuesday. If you'd asked us in the early autumn, we'd have said that equivalence is vitally important for every area and need to be sorted out, but things have developed. Equivalence has a short shelf life, said Baroness Rita Donaghy, Chair of House of Lords Committee reviewing the future of UK-EU relations. She urged the UK to strike a close relationship with the EU, but admitted, the atmosphere at the moment is rather cool, and that doesn't help. European rulemaking was often a balancing act between Britain, France and Germany. Now that the UK has departed, the EU is going back to its bank-based system, and Britain will have much more flexibility to adapt its rules than the EU, said Karel Lano, Chief Executive of European think tank CEPS. It reminds me of the wholesale changes we have gone through the last 30 years. The UK had a diverse, very much self-regulatory system before the single market started, he noted. Nevertheless, the UK's new system may leave Parliament with less ability to scrutinise rules and hold regulators accountable, Baroness Donaghy warned. And that sounds quite correct. Government and regulators now hold significant power in setting financial services regulation. Still, while the UK and EU are likely to go separate ways on important parts of financial rulemaking, there are also areas where they may overlap. This year, both London and Brussels will change unsuccessful parts of the mammoth banking and markets legislation designed to improve the financial system after the 2008 crisis, such as MiFID II, Solvency II for insurers, and CRR, which covers bank capital. The EU may also mimic the UK's plans on failed trades, and both are looking at the rules to boost competition in Europe's future markets. The so-called open access regime allows investors to use a clearinghouse of their choice, but they have repeatedly been delayed. Even then, there may be nuanced but important differences. In a series of quick fixes to MiFID II, Brussels has raised the cap on the amount of commodities contracts traders can hold to 300,000 lots per trader. But the UK is looking to go further because its markets, which include Brent crude oil futures, are much bigger and more global, according to 3 people familiar with the government's thinking. Under consideration are plans to let exchanges manage traders who hold large positions. The exchange would also decide limits to the size of blocks of trades that are agreed privately away from the market. A talking shop to enhance regulatory cooperation and compatibility between London and Brussels is expected to be finalized by the end of the month. But the accord is likely to be rare common ground, as each side uses Brexit as a chance to strike out and tailor regulation of major markets like equity, futures and fixed income to their own philosophies. As McGuinness noted on the EU's equivalence decisions, there is no rush. And to be honest, with the divergence, an important part of the EU legislation will be gone in the UK. The main target of the legislation in the EU has to be to prevent tax evasion. We have new laws for that have to be in place this year. And many of the regulations being discussed in the UK now make tax evasion easier. And that's why I believe the more they diverge, the less equivalence is there. And we will see in the future. But if you want to stay informed, please subscribe to my channel. Auf Wiedersehen.